Good afternoon and good morning for those of you on the West Coast. And thank you all for joining today's webinar, Investing in Opportunity Funds and Opportunity Zones, How to Take Advantage of the New Federal Tax Incentive. My name is Nick Melillo, and I'm a partner at BakerHostetler and a member of the firm's real estate team. With the evolving landscape of Opportunity Zone regulation, we thought it would be beneficial to share some pertinent information and current trends. We have a great panel for you today. My colleagues Alex Silvis, Christina Novotny, and Lucas Witters will be presenting. Alex is a partner in the firm's tax group. He's been an attorney at the firm for more than 30 years and is co-leader of the firm's tax credit finance and economic development incentives team. He has significant experience and advises regularly on tax considerations and structuring of transactions involving real estate and businesses, including areas such as partnership taxation and 1031 exchange transactions. He also works extensively in the areas of tax planning and structuring for projects seeking to utilize federal and state tax credits, especially historic and new market credits, as well as other tax advantage and non-traditional sources of financing, including opportunity funds. Alex has been a frequent speaker on tax-related topics at numerous accredited CLE programs. We also have Christina, who is tax counsel here at Baker, where she's practiced law for 12 years. She's also a certified public accountant and was a practicing CPA at two of the Big Four accounting firms for 5 years prior to becoming a tax attorney. Her practice focuses on the federal tax treatment of real estate transactions involving partnerships, federal and state historic rehabilitation tax credits, federal and state new market tax credits, and 1031 exchanges. She also has significant experience dealing with the financing and structuring of projects seeking to utilize tax credits, opportunity fund dollars, and other tax-enhanced forms of funding. Lucas is a tax associate with the firm. He has broad experience in areas of income tax, with concentration on tax advantage project finance, tax-exempt organizations, and transactional tax matters. He represents developers and other clients in the creation and implementation of tax-efficient financing and transaction structures, including those involving tax credits and opportunity funds. Our program today will last 1 hour and is approved for 1 hour of CLE credit in Arkansas, California, New York, Pennsylvania, Texas, and Washington. Credit is pending in Colorado, Florida, Georgia, and Ohio. For all other states, credit will be applied for as requested, and attorneys can receive a certificate of attendance and electronic materials so they can file directly with CLE credentialing entities. New Jersey credit is available via reciprocity. During the course of the webinar, we'll share 2 codes that you'll need to enter into a brief CLE questionnaire immediately following the program. Please stay logged into the presentation system for this questionnaire to appear, and please make sure to answer all of the questions if you'd like us to submit for CLE on your behalf. If you have any questions during the presentation, you can type your questions in the bar on the right side of your screen. We'll try our best to answer them at the end of the program, time permitting. If not, we will follow up with you after the webinar. We'll provide our contact information at the end of the program so you may contact us at any time with comments, suggestions, concerns, or questions. We'll also send an email to everybody in the next day or two with a link to the recording of the webinar. Again, thank you for joining us today and hope you find the presentation helpful. With that, I'll turn it over to Alex, who will begin today's presentation.
Thanks very much, Nick. Hello also from Christina, Lucas, and me to everyone who's joining us today for the webinar. Thanks very much to all of you who registered for our program. We're very excited about having this next hour to spend with you discussing the terrific new tax incentive involving investments in opportunity funds and opportunity zones. From the registrations that we've received, we really have an outstanding group of attendees participating in today's webinar, covering quite a range of industries, from a broad spectrum of real estate companies and developers to many types of operating businesses. And also from investment funds, wealth managers, family offices, and many others. Our goal will be to try and present this program in the Opportunity Zone information in a way that's relevant and practical to all, given the wide expanse of who our audience is today. And similarly, we have folks joining us on the call today who range from business executives to investment professionals and fund managers, to tax directors and other tax professionals, to corporate and real estate counsel. So we're really delighted to have what is an outstanding, sophisticated group of attendees, although once again, with a range of different experience levels with and different perspectives on the Opportunity Zone program and opportunity fund investments. We're expecting that a number of the folks on the call already have been in the trenches working through some of the details of trying to structure and execute on opportunity fund transactions, and that some of you have already attended previous programs dealing with OZ. So your interest may be primarily on newer developments, including important new guidance that we received in the latest set of proposed regulations. So we'll definitely be focusing on that in the presentation. But we also expect that a number of executives and others on the call may have more of a big picture interest and understanding of opportunity zones and opportunity funds. So while they're familiar certainly with the capital gain tax deferral and potential exclusion benefits of the program, they may not be, and frankly probably don't want to be, all that well versed in the details and the technical side. So we'll aim to convey the key points here today without getting too deep into the weeds. In order to try and accomplish all that, the way we'd like to proceed here is that I'll provide a little background and give a short overview of the Opportunity Zone program, and then I'm going to turn it over to Christina, who will take us through the key rules and requirements for qualifying Opportunity Fund and Opportunity Zone investments, including the potential federal tax benefits involved, and then also structuring alternatives and considerations. And then Lucas primarily will take us through the highlights of some of the important new guidance that came out from Treasury and the most recent set of proposed regulations that were issued in April of this year. Then I'll wrap it up with some state tax considerations for Opportunity Zone investments, and also some thoughts on the continuing vitality of Section 1031 of the Code in light of the enactment of the Opportunity Zone regime. So with that, let's get into the formal presentation. The Opportunity Zone rules were enacted as part of broad-based tax reform legislation at the end of 2017, and you'll recall the focus at that time was really on the very big changes that were going on with things like corporate tax rate reduction and international tax reform, and significant changes to the deductibility of things like business interest and state taxes for individuals. So really big things were going on in the tax world at the end of 2017, and the Opportunity Zone rules were not at the top of many people's list at that time. Even in areas like real estate finance and tax-advantaged investing, many industry folks, as well as tax professionals, were focused on some really important industry matters that were in play in that tax legislation, like trying to preserve tax credits and Section 1031 exchanges and depreciation and interest expense benefits. And so not many people were focused on trying to obtain a new tax-favored incentive as part of the 17 legislation in the form of opportunity zones, even though a bill that had been, containing these rules had been percolating on Capitol Hill for some time prior to the 17 Tax Act. But sure enough, what was included in the year-end 17 Act, which is now codified in new Internal Revenue Code sections 1400 Z1 and 2, is the Opportunity Zone program. And the purpose of the program is really to create a powerful economic development incentive that's intended to drive investment capital into certain designated areas by providing tax incentives to draw capital into places where it otherwise likely would not flow. In order to try and spread out the areas targeted for investment throughout the country, you can see from slide 3 that the Opportunity Zone legislation provided that the governors of each state could designate 25%. That is only 1 out of every 4 of the defined low-income community census tracts that met certain average median income and poverty level criteria in their respective states as a qualified opportunity zone. So while they used the same criteria as are utilized for the new markets tax credit program, unlike new markets where all low-income community census tracts are eligible for new markets investment, only 25% of those tracts, as selected by each state, are eligible for opportunity zone benefits. Slide 3 in the deck also notes that there's a few exceptions to that 25% limit, and those are that states were able to designate a minimum of 25 of their low-income tracts as qualified opportunity zones in any case. And for Puerto Rico, all of its low-income tracts are automatically considered to be qualified opportunity zones. That selection process went on early last year, with each state then conducting its own analysis and making its designations by the statutory deadline dates, which were last spring. and then submitted those to Treasury, which then certified the opportunity zones by summer of last year for each state. Those designations are effective for 10 years, which is essentially the life of the Opportunity Zone program as it's currently constructed for reasons that we'll describe shortly. And there's no mechanism in the statutory rules currently to allow for any modification of the designations that have been made. So we're locked into what we have at this point. If you take a look at slide 4, you can generally see the location and the spread of the opportunity zones throughout the country. Slide 5 shows the opportunity zones in Ohio as an example. And you can see that there are clusters around the major cities like Cleveland and Columbus, Cincinnati, Dayton and Toledo, and so on. But you can also see there's quite a number of opportunity zones in less populated sections of the state that aren't near any urban areas. And that's fairly typical of most states. Slide 6 also shows the qualified opportunity zone in the state of New York. And incidentally, we included Ohio and New York in particular here because we happen to have the greatest numbers of webinar attendees who are registered from those two states today. On slide 7, we've also included Florida opportunity zones because we also have a good number of folks dialed in to the webinar from Florida. But we at Baker also have a large Orlando office, and we're involved in a number of opportunity funds in the state of Florida, as well as some potential opportunity zone development projects there. Since the enactment of the statute and then the certification of the opportunity zones last summer, what we've received are 2 sets of proposed regulations. The first came out in October of 2018, and then the second set was issued in April of this year. And with that as the background, I'd like to turn things over now to Christina so she could talk about some of the key rules for investing in opportunity funds and opportunity zones.
Thanks, Alex. So as Alex said, I'm going to start going through the main opportunity zone program rules. Most of them, this is going to be statutory, but I'll kind of share when one of the rules, what is maybe in one of the proposed regulations. So to start, what does a taxpayer have to do to get the opportunity zone tax benefits, which again, I'll get into? Essentially, to the extent a taxpayer has a capital gain from the sale or exchange of property to an unrelated person, he generally has 180 days to invest the amount of that gain into what's called a qualified opportunity fund, which I'll get to what that is next. And in order to obtain the favorable tax benefits, which again, I'll also get into what that is. So this slide really goes to the timing requirement. So the general rule is 180 days from the sale or exchange that generated the capital gain. But there are some special rules. So first, pass-through entities. So for example, what if you're a partner in a partnership? So first, the partnership can elect to invest its capital gain dollars on behalf of the entire partnership in a qualified opportunity fund, again, on behalf of its partners, within 180 days of the sale of its property that generated the capital gain. However, if it chooses not to, each partner has the opportunity to invest his allocable share of the partnership's capital gain. Again, I keep using partnership, but this is really for flow-through entities, partnerships or S corporations. So again, the partner has the opportunity to invest his allocable share of the gain within the partnership's 180-day period. So again, within 180 days of the partnership's sale of the property that generated the gain, or in recognition of the fact that partners may not always know that the partnership sold property that generated capital gain until the end of the partnership's tax year when the partner gets the K-1. The first set of proposed regulations provided a nice rule that said that a partner can also choose to start his 180-day period at the end of the partnership's tax year. So there's a little more time for that partner to recognize that the partnership had a capital gain, get his K-1, see his allocable share, and then again, he'll have 180 days after the end of the partnership's tax year to invest. There's also a special rule for 1231 gains, which are generally gains from the sale or exchange of trade or business assets. Because 1231 gains are only taxed as capital gains to the extent net 1231 gains after basically offset with 1231 losses, this is the second set of proposed regulations, which again, Lucas will get into and also Alex later, that kind of said, well, we don't know, you're not going to know which part of your 1231 or how much of your 1231 gain is going to be taxed at capital gain rates until year end. So your 180-day period for net 1231 gains taxed as capital gains will also not begin until year end. So again, general rule 180 days from the sale, but there are some special rules. And again, Alex will go into a little bit more later on the 1231 issue. So now that you have you invested in a qualified opportunity fund, what exactly are the tax benefits? So this slide kind of goes through the mechanics of what the benefits are. But essentially, for any eligible capital gain invested in a qualified opportunity fund, as long as you meet certain rules, you have the opportunity to permanently exclude 15% of your capital gain from taxability altogether, defer the remaining 85% of the gain until the earlier of 2026, or you dispose of your fund investment in some manner by way of what I'll call an inclusion event, which is something that the second set of proposed regulations created, and Lucas will talk about that a little bit later as well. But as long as you hold on to it, the fund interest, you can defer recognizing capital gain until 2026. And if you hold your fund interest for at least 10 years, you have the opportunity to permanently exclude any appreciation of your fund investment from taxability. So there's a lot of benefits here, and I think it might be easier to follow with an example or might be helpful, so I'm going to go through a very quick example. So say you have a $100 capital gain. You take that $100, you invest it in a qualified opportunity fund. The taxpayer has an initial zero tax basis in its fund interest. If you hold your fund investment for at least 5 years, you get to increase your basis in your fund interest by 10% of your originally deferred gain. So in my example, 10% of 100, $10. So your basis bumps up $10. You hold your fund interest for at least 7 years, you get an additional basis increase of 5% of your originally deferred gain. So in my example, 5% of $100, $5. Your basis is now $15 after year 7 of holding your fund interest. You haven't paid any tax on that capital gain either at this point. So assuming you still hold your fund interest on December 31st, 2026, then the difference between your originally deferred gain or fair market value of that fund interest, if it's less, I'm going to assume that's not the case here. So your originally deferred gain of $100 and your basis is now recognized. So $100 minus 15, $85. So at this point, you do have to recognize $85 of capital gain, but you've deferred it, say you invest in 2019 until 2026, and you've permanently eliminated 15% of that gain. So now, even further, say you invest in 2019, it's 2030. You've held your investment for over 10 years. When your investors, when you sell your fund interest now, you get a further basis increase to fair market value, and that's going to serve to permanently exclude the appreciation from taxation. So say you sell your fund interest now for $150. You originally invested $100. You've benefited by $15. You've realized the gain of $50, 150 compared to 100. But your basis is now 150, so you don't pay tax on any of that realized gain of $50. So that's really all of the tax benefits are great, but this is kind of the carrot. If your fund interest appreciates significantly and you hold it for a long term, you can again avoid being taxed on any of this appreciation. Now, the statute only provided for this benefit if the investor sold his fund interest after holding it for 10 years, not if the fund sold its underlying assets. So that rule kind of limited the available exit strategy for these investments, but the second set of proposed regulations provided some relief there, and Lucas is going to get into that later, but I just wanted to mention that here. So now I'm going to go into some definitions. So I said before, the initial requirement is you have to invest in a qualified opportunity fund within 180 days of your gain. So what is a qualified opportunity fund? There's not a lot of requirements. Essentially, it's either a tax partnership or a corporation that holds at least 90% of its assets in qualifying property on an annual basis. So the statute generally provides that you determine if the 90% test is met by averaging the fund's property twice a year, generally by looking at the fund's property at the end of the first 6-month period and the end of the year. But there were some concerns about how this would work for the fund's first tax year after the statute came out, because, for example, what if a fund is formed on December 15th, it has a calendar year end, you don't have really a 6-month period. The statute would say that you really have to have 90% of the cash that the investors invested in the fund invested in quote unquote qualifying property within 15 days, which doesn't really sound fair when the main rule is 6 months, but just how it would work out, that would be the technical requirement. So recent proposed regulations provided some relief on this test as well. And again, Lucas is going to get into that a little bit later, but the overall rule again is 90% of the fund's assets have to be in qualifying property. The fund also has to self-certify in a sense by attaching an IRS form to its tax return to note that it's intending to qualify as a qualified opportunity fund, and annually it also has to file a form to show that it's meeting the 90% test. But again, there's not a lot of requirements. And I go back to the main requirement is the whole that the fund has to have 90% of its assets in qualifying property. So what is qualifying property? At fund level, it's either qualified opportunity zone business property, qualified opportunity zone stock, or qualified opportunity zone partnership interest. But essentially, qualifying property is qualified opportunity zone business property that's either held directly by the fund or held or where a fund invests in a lower tier entity that acquires that qualifying opportunity zone business property. So moving on more definitionally, what is qualified opportunity zone business property, which is essentially really what the fund has to invest in for all of the investors to get their tax benefits. So it's tangible property used in a trade or business, substantially all of the use of which is in a qualified opportunity zone. It has to be acquired after December 31st, 2017 by purchase from an unrelated party. And either the original use of the property within the opportunity zone begins with the fund, which would often apply to perhaps like personal property where it existed somewhere else, the fund buys it and brings it into the opportunity zone to use in that zone. Or for property like real estate that has always been in the zone, is not movable, so you really can't technically have the original use in the zone, you have to substantially improve that property, which generally means that you have to make improvements to the property over a 30-month period in an amount that exceeds the adjusted basis of the property at the beginning of that 30-month period. So the crux of these requirements is really to make sure that these are new investments in opportunity zones, so kind of bringing development to opportunity zones, and that they were really incentivized by this opportunity zone program. So the next slide, and as I mentioned before, the fund can kind of set up a structure where either it owns the qualified opportunity zone business property directly or through a lower tier entity. This slide really just shows a very simple depiction of a direct, what I'll call a direct investment structure, where you have the qualified opportunity fund in the center, which again I said is either a tax partnership or corporation. I've depicted it here more so as a partnership. And on the right-hand side, you have your opportunity zone investors that are going to make capital contributions of eligible capital gain dollars into the fund in exchange for an equity interest therein. And then the fund is going to take those dollars, and essentially it has to take 90% of those dollars and invest them in qualified opportunity zone business property. So it's a fairly simple structure when you depict it if you're going with the direct structure. But I also said that a fund can invest in qualifying opportunity zone property indirectly by first investing in either a lower tier corporation or a partnership. If the fund chooses to invest in that way, the stock or the partnership interest that it acquires has to be acquired, again, after December 31st, 2017, and it has to be solely for cash. And essentially the fund would have to, if this is the only asset it holds, it would have to at least hold, it would at least have to transfer 90% of its cash, make a capital contribution, 90% of its cash down to the corporate partnership to take back an interest. And the corporation or partnership has to be what is referred to as a qualified opportunity zone business. So another defined term, which I'll get to what that is in a minute. But just kind of going back to a structure example, this is what we've referred to as kind of an indirect opportunity zone investment structure. So really we just essentially have one more entity. So the fund in this structure is on the right-hand side. Again, the opportunity zone investors will make capital contributions of their eligible capital gain dollars into the fund. And then this, instead of, again, the fund on the right investing directly in the qualifying property, it's going to make a further cash capital contribution down to the lower tier project entity that's got to qualify as a qualified opportunity zone business. Again, it could be a corporation or a partnership. I've depicted it here as a partnership. And then that entity has to take the cash it receives and that invest in qualifying opportunity zone business property. So still not just really adding one more level here for the quote unquote indirect structure. So I said that this lower tier entity has to qualify as a qualified opportunity zone business, which includes additional requirements. So you might initially kind of think, well, the direct structure is simpler. You don't have that extra layer. And if the qualified opportunity zone business, there's additional requirements, why would I really want to set up an indirect structure? But as I walk through these requirements, it'll become clear that there are some benefits. And a lot of times this is the most beneficial structure. I would say oftentimes this is the most beneficial structure that we've seen for opportunity zone investments. So walking through these requirements, the first is that at least 70% of the tangible property that's owned or leased by the lower tier entity has to be qualified opportunity zone business property. So right off the bat, this is somewhat of a different percentage test. So if the fund invested directly in the qualified opportunity zone business property, 90% of its assets have to be qualifying property. If you choose to use an indirect structure, 90% of the fund's cash would have to go down into this lower tier entity. But at that level, this lower tier entity only has to have 70% of its property in quote unquote qualifying property. So there's more flexibility here if you do the indirect structure, more opportunity to hold non-qualifying assets or cash. The next two requirements are really sourcing rules. So at the lower tier entity, at least 50% of the income of this entity must be derived from the active conduct of a trade or business within the opportunity zone. And a substantial portion of the intangible property of the lower tier entity has to be used in the active conduct of a trade or business in the opportunity zone. And as I note on this slide, the second set of proposed regulations have provided some additional clarity with these requirements, which Lucas will go into. And I'm going to skip down to the last requirement here for a minute, just to reorder a little bit. Another requirement is that this lower tier entity cannot operate what's referred to as a spin business. This kind of comes from the new markets world, if participants are familiar with that. There's just certain types of activities that the government has said we do not, we're not going to kind of subsidize you to engage in. So certain amount of sin businesses are like golf clubs, country clubs, liquor stores, just certain things you cannot do. And then moving back up to the fourth bullet point, this last requirement is the one that's provided probably the most concern initially, was that less than 5% of the average of the aggregate unadjusted basis of the lower tier entity's property can be attributable to what's referred to as non-qualified financial property. And again, as I noted, this was a big concern prior to the first set of proposed regulations being released, because non-qualified financial property includes cash, unless such cash qualifies as reasonable working capital. But the statute didn't define what was reasonable working capital for purposes of these rules. So taxpayers were concerned that they would fail this test unless the cash invested by the fund into the lower tier entity was essentially immediately used to buy qualifying assets, which wouldn't work if you're doing any type of redevelopment or substantial improvement project. You wouldn't be able to use the cash that quickly. But when the first round of proposed regulations came out, they provided a safe harbor, which said if you meet certain requirements, you would be deemed not only to meet the non-qualified financial property test, even if you had cash sitting on your books, but generally all of the other kind of subsidiary qualified opportunity zone business requirements, you would be deemed to met during the redevelopment or substantial improvement duration. So these requirements are on this slide, and they're essentially that what you have to have is a written plan that identifies your otherwise non-qualified financial property assets. So typically it's going to be your cash. as property that's held for the development of a trade or business, including acquisition, construction, or substantial improvement of tangible property in a qualifying zone. There's a written schedule that's consistent with the ordinary business operations of the lower tier entity, showing that the assets and essentially the cash is going to be used within 31 months, and the lower tier entity substantially complies with that schedule. So this was very welcome to taxpayers, and the takeaway here is that if you'd like to make an opportunity zone investment to do a kind of longer term redevelopment construction project that will take up to 31 months, you should generally be able to do that, even though cash is generally not qualifying, opportunity zone property, as long as you structure it using kind of the indirect method and you meet this non-qualified financial property safe harbor. So that was a kind of quick go round of the main rules. And at this point, this is your first CLE verification code. So I would write this down for the end of the webinar. All right, and I'm going to turn it over now back to Alex for a brief introduction of the proposed regs.
All right, Christina, that's great. Thank you for giving us that really the essential requirements and alternatives for structuring opportunity zone, opportunity fund investments. We're now going to take the second half of the program to really drill down on new guidance and what the proposed regulations in particular gave us to clarify some of the requirements. And we're really seeing the second set of regs was quite helpful in answering a number of open questions previously that had kept people on the sidelines still. And we have really seen already quite an uptick in activity since the proposed regs have come down. Prior to that, the government issued, as I said, the first set of regulations back in October of 2018. That gave us some helpful guidance. Then it took them another 6 months to give us the second tranche that answered a lot more questions, and they gave us 169 pages of regulations in that second set. But these do answer a lot of questions, and so we have seen capital begin to flow a lot more than previously, where it was a good number of private transactions, but the fund activity was fairly limited, I would say. And so, again, now moving into what the proposed regs really do for us, I'm going to take the first item here, which received about as much comment, I think, and criticism as any of the points in the new regulations, and that was the treatment of so-called 1231 gains that Christina alluded to, before. So for the non-tax, folks on the call, the 1231 is tax speak for the section of the code that deals with the tax treatment of gains and losses on the sale or exchange of depreciable or real property used in a trade or business that's been held for more than a year. So what section 1231 does is require a netting of all the gains and losses from the business property to determine if there's a net 1231 gain. And in that case, the net gain is treated as capital gain. So even though the statute, the Opportunity Zone statute, section 1400D2, clearly says that the time for reinvestment for Opportunity Zone purposes runs from the date of the sale or exchange, Treasury in the new proposed regulations says that for 1231 assets, those trade or business assets I was referring to, since under section 1231, a taxpayer cannot determine whether or not it's going to have any net 1231 gain until the very end of the tax year, when it's done its netting of gains and losses for 1231 property and made a computation of that. Treasury said, well, for 1231 property, the 180-day period for investing the net gain into an opportunity fund only starts at the end of the tax year. Now, that could be a big problem for a taxpayer who has a large gain from a sale of a 1231 asset, let's say during 2019, and he's already invested cash equal to his 1231 gain from that sale within 180 days of the sale during 2019, as he thought the statute, provided for him to do, or he would like to invest those dollars into an opportunity fund yet this year and then deploy them into qualifying opportunity zone investment yet this year. But under the Treasury's reading that's contained in the proposed regulations, the taxpayer's 180-day time period to reinvest that capital gain doesn't start until the end of the tax year and runs until May 29 of 2020. So the taxpayer's investment prior to that time, that is in 2019, into an opportunity fund seemingly would not qualify. And that portion of the proposed regs has received a lot of criticism, understandably, because there really isn't any intent or reason to cause folks to delay deploying capital into the targeted census tracts and achieve the objectives of the Opportunity Zone program. So there's been a great number of comments that were submitted to Treasury to modify this proposed treatment. And by the way, on the comments, so I mentioned the regs came out in April. They formally were published May 1, so there was a 60-day comment period that ran until July 1 on the new proposed regulations. So a tremendous number of comments have been submitted to Treasury, and there was a public hearing that began this week, actually, just on July 9, spilled over to yesterday, July 10, with about 20 witnesses speaking there. And so, in any event, from all those comments and a lot of input, the hope would be that for 1231 ruling, the rules for OZ, that Treasury would allow a taxpayer to elect to invest his gross 1231 gain from a sale, and to elect to do so, within 180 days of the sale during the same tax year, and not have to wait until after year end, and at least permit the net 1231 gain, as it's ultimately determined at the end of the year after the netting, to qualify. And so to the extent the taxpayer invested more because he invested gross gain and he ends up with less 1231 gain, at least the net portion should be eligible, and then the excess will be treated as an after-tax investment under there's some special rules for mixed investments under the Opportunity Zone rules, and that's how you deal with amounts above the net. Slide 20 does note the Treasury did recently grant some relief for those who are in this predicament for 2018, but it's limited to just 2018. So we really do need a change in what the proposed regs say in the final form in order to give taxpayers relief for 2019. One other area of uncertainty on the next slide is at the partnership level, and whether partnerships can net their 1231 gains and losses and invest the partnership 1231 gain into an opportunity fund. So without having to do that at the partner level, with the partner taking account all its 1231 losses to come up with its net gain. And there is some optimism on this point, frankly, as well as on the prior really significant point that I talked about, based on conversations and informal comments that Treasury officials have made. So we're hopeful, but at this point, we don't yet have that clarification. All right, Lucas, you want to pick up the next item?
Great, thanks, Alex. I'm just going to continue working through some of the highlights of the second tranche of proposed regulations. So first on slide 22 here, there were some expansions, you may call them, with respect to the 10-year exclusion benefits. The proposed regulations provide an election to exclude capital gains on a sale of qualified Opportunity Zone property by a pass-through fund. So taxpayers that hold direct interest in a qualified opportunity fund that is a partnership or S corporation and hold that interest for at least 10 years can elect to exclude from their gross income all or some of the capital gain generated by a disposition of that fund's qualified Opportunity Zone property. So this will give taxpayers a little bit more flexibility in exiting their fund investment while still allowing them to benefit from the exclusion from income of post-acquisition appreciation of that fund interest. So the proposed regs permit the exclusion of gain on sale of qualified Opportunity Zone property held by the fund for less than 10 years, as long as the taxpayer has held its interest in that fund for at least 10 years. This is not without limitations, though, in the proposed regulations. It is limited to capital gains on the sale of qualified Opportunity Zone property, unlike the more general 10-year basis step-up election that's available on the sale of your fund interest. which is available with respect to the fair market value of all assets of the fund. The new proposed regulations also do not expressly permit gains from the sale of assets by a subsidiary qualified opportunity zone business that flow up to the qualified opportunity fund to be excluded, which, as Christina outlined before, that sort of indirect structure really is probably the preferred route for most folks. So potential obstacle there, although the regulations don't expressly address it either way. So it leaves open the possibility that further relief could come here. And if a fund gets a gain on its K1 from a subsidiary business, maybe investors in that fund could get this election available for that gain flowing through to them as well. Next highlight, and this was a welcome one certainly, as Christina outlined, is some relief from the 90% asset test for the Qualified Opportunity Fund. The proposed regs provide a 6-month grace period for contributions to the fund. Namely, you get 6 months for calculating the 90% asset test for qualification of the fund that Christina outlined. A Qualified Opportunity Fund can disregard property it receives within 6 months prior to its applicable testing date. However, it has to hold those contributions in cash, cash equivalents, or short-term debt instruments with a term of 18 months or less. This truly is a broad election. You can pick and choose from testing date to testing date. A fund does not have to be consistent from one testing date to another with respect to whether it takes advantage of this option. It's not something that you're locked into once you do it. Continuing on to slide 24 here, the proposed regulations offered some additional relief from this 90% asset test, namely with respect to reinvestment proceeds. So proceeds that are received from the sale of qualified opportunity zone property will continue to be treated as qualified opportunity zone property for purposes of this 90% asset test, as long as they are reinvested in other qualifying property within 12 months. However, again, similar with respect to the contributions, in the interim, those proceeds have to be held in cash, cash equivalents, or short-term debt instruments with a term of 18 months or less. However, while they still qualify in the interim, these proceeds as qualified opportunity zone property, even if you reinvest them within the 12-month period so that they maintain their character as qualified property all along, the sales are still taxable, subject to the 10-year exclusion rules that I outlined on slide 21. So there's some relief for reinvesting sales in the interim while you're holding your fund interest, but only that more limited relief to actually exclude gain from those sales. Another highlight, and certainly a welcome one from the proposed regulations, was clarifying when leased property can be qualified opportunity zone business property. More specifically, leased tangible property can qualify as qualified opportunity zone business property under the proposed regulations if you entered into a lease for the property after year-end 2017, and if substantially all the use of that leased property is in a qualified zone for substantially all the period that it's leased. If you're trying to take advantage of this, your lease has to be a market rate lease, and that's determined under Code Section 482. If you are leasing real property other than unimproved land, there cannot be any plan for the fund to later purchase that property at other than fair market value. It's probably a sensible anti-abuse rule there. And then if there is a lease between related parties, as Christina outlined, generally you have to buy qualified property from an unrelated party, but there is a possibility to lease from a related party subject to some additional conditions. More specifically, if you are leasing what you intend to be qualified property from a related party, the lessee cannot make a prepayment of rent for in excess of 12 months. And with respect to tangible personal property, the original use of that leased property does not start with the lessee. The lessee has to acquire other property other than by lease that has a value at least equal to the value of the leased property in order to continue qualifying. So if you're going to use leased property to qualify, you need to know how to value it, of course. There are two potential methods here. The first is a financial statement valuation method. Simply enough, the value of your leased property is as reported on an applicable financial statement for the relevant period. However, this only works if the financial statement is prepared in accordance with GAAP. So what do you do if you don't have GAAP-basis financial statements? There is a second alternative available to you. Also pretty simple. The value of leased property under the second method is determined based on the present value of the rent payments, and you make that present value calculation using the applicable federal rate as your discount rate. Some more positive clarifications in the proposed regulations with respect to land as qualified opportunity zone business property. So the first tranche of regulations that came down noted that land cannot have its original use in a qualified opportunity zone, which, as Christina outlined, is one of the requirements for qualified property. Also noted that land acquired by purchase does not need to be substantially improved if an existing structure on that land is substantially improved. But again, the big obstacle here is that the general rule is that land is typically going to be a bad asset because it can't be deemed to have its original use in the qualified opportunity zone. But the second tranche of regulations provided some more helpful guidance here. Namely, land can be qualified opportunity zone business property if unimproved, if you are using it in a trade or business within the meaning of Section 162. However, if you're just holding land for resale to generate a gain, that's not going to qualify as a trade or business under 162. But if you have a special circumstance where somehow raw land would be deployed in a trade or business, that can be qualifying property. Furthermore, the second tranche provided that unimproved or minimally improved land purchased with an intention or not to improve the land by more than an insubstantial amount within 30 months is not qualified opportunity zone business property. So sort of just the inverse of the safe harbor for construction that Christina outlined. However, we don't have a definition for what an insubstantial amount would mean. And lastly, with respect to land here, there's no qualified opportunity zone business property eligibility for land that was owned prior to 2018. However, newly constructed improvements on land purchased prior to 2018 or acquired from a related party should still be able to qualify as qualified opportunity zone business property. However, neither regulation expressly stated that, but it seems like the natural rule that should have to apply. And one last point here, a lease of land to a qualified opportunity zone business at fair market value could assure qualification of the improvements, but that may not be necessary here. We just haven't had express confirmation in the guidance we have so far. Some further clarifications in the second tranche of regulations on original use rules. So again, generally the original use of tangible property in a qualified opportunity zone starts on the date that it is first placed in service for purposes of depreciation or amortization of the property. So this could be a helpful benefit. It allows a purchaser of construction in progress to count that constructed asset as its qualified opportunity zone business property, even if it wouldn't have independently substantially improved it if that purchaser is the one who first places it in service. So if you came in to buy a midstream construction project, as long as you buy it before they pull a CO and place it into service, that can be qualified property, even if you hadn't exceeded your basis with that last bit of the construction. Another helpful point here, used property can satisfy the original use requirement if it had not been previously used or placed in service in the qualified opportunity zone before you purchased the used property. And lastly, on original use of vacant or unused property will be deemed to start on the date that it has been used or placed in service in the zone. If it had been vacant or unused for 5 continuous years, you can call that original use if you place it back into service. So as Christina outlined in the general rules, at least 50% of a qualified opportunity zone business's gross income has to come from the active conduct of a trade or business in a qualified zone. And the regulations provide some safe harbors for that calculation. So first, based on the hours worked, if at least 50% of the services performed for a business based on number of hours by its employees and independent contractors are performed within the zone, you satisfy a safe harbor for that 50% gross income test. Second, based on amounts paid for services. If at least 50% of the services performed based on your payments to the performer are by employees and independent contractors within the zone, you satisfy the 50% test. And finally, there's a third safe harbor for location of management and tangible property. If a business is tangible property that is in a zone and the management's operation functions performed for the business in the zone are each necessary to generate 50% or more of the gross income, that business will be deemed to derive 50% of its gross income from the zone. And finally, just to reiterate, these are safe harbors. Truly, you don't have to meet any of those if you can still prove, based on all facts and circumstances, that your business generates at least 50% of its gross income from active conduct of a trade or business in the qualified zone. So last couple of points here in the proposed regulations. This one was probably one of the more bitter pills to swallow with respect to consolidated groups. The proposed regs do not treat stock in a qualified opportunity fund as stock under Section 1504. So a fund could therefore be the common parent of a consolidated group, but it cannot be a subsidiary member of the group since its stock wouldn't qualify as stock for that purpose. Treasury did specifically request comment on the issue. We certainly know of at least one industry working group that requested that an entire consolidated group be treated as one taxpayer for purposes of the rules. This one was, I'm sure, one of the more disappointing rules to come down for people who are already planning with a fund in their group. The regulations also clarify that 1400Z applies separately to each member, so you can't mix and match who sells property and generates gain and who reinvests the gain in the zone. That has to be all the same member of your group. A couple more helpful points, I guess, on consolidated groups. The regs do make clear that basis adjustments for the investments that you hold in a fund for 5, 7, and 10 years are treated as tax-exempt income under the 1502-32 regs. So you're going to get to tier up those basis adjustments through your group so you don't get stuck with a gain somewhere upstream that was meant to be eliminated by the program. And finally, a sensible anti-abuse rule. The regs provide that for purposes of the 1502-36 anti-loss duplication rules, you can't reduce your basis in a qualified opportunity fund investment to tier a loss duplication when that basis would later be booked up in accordance with the program. So the last point here on the proposed regulations. So the statute itself talked about the deferred capital gains being included in a taxpayer's income in the taxable year that included the earlier of the date on which the investment was sold or exchanged, or year in 2026. However, a conference committee report outlining the statute used the term disposition rather than sold or exchanged, and Treasury used that as a launching pad to create this whole category of inclusion events, they called them, that would require you to recognize all or a portion of your deferred gain. So the proposed regulations provide certain enumerated events to the extent that they either reduce your equity interest in the fund, result in a distribution to the taxpayer from the fund for federal income tax purposes, or result in a worthlessness deduction, can be inclusion events. And they provide some examples of those, namely termination of the fund, transfer of your investment in the fund by gift, distribution from the fund in excess of your basis, and that's either your outside basis in a partnership, or if you run out of E&P and basis and you get gain from a stock. Either way, that's going to be treated as an inclusion event. Liquidation of a corporation under either 331 or 332 is going to be an inclusion event. If you contribute your stock in a fund to another corporation in a 351 deal, that's going to be an inclusion event. B reorg, in which a fund stock is exchanged for other stock, is an inclusion event. And distribution of qualified opportunity fund stock by one of its shareholders in a 355 spinoff, also an inclusion event. They do provide some helpful exclusions to this. Transfers on death, 721 transactions, and distributions that are not in excess of your basis to generate gain will not be inclusion events. Here we have your second code, so please take a minute to write this down. We're not allowed to repeat them. So give you a couple seconds here to write down your second CLE code, and then I will turn it back to Alex to talk about some analogous state programs.
All right, great. Thanks, Lucas. I'm just going to make a couple of what I think are important points regarding the state treatment. So slide 33, the state tax treatment is quite significant also, and the tax professionals on the call know this well. But for other folks, I think there often is a general assumption that the federal benefits and what you get for federal is going to carry over and you'll get that benefit for state. And that clearly is not necessarily the case. You need to know what state you're operating in and what their rules are, because there are states where you've got, for example, individual income tax rates of north of 10% without any preference for capital gains could be taxed as ordinary income. And folks would have a, very unpleasant surprise if they thought they obtained the same deferral by taking advantage of the OZ program they get for federal, for state purposes, and they get a large bill. So the end of the day, by now, there's various different treatments by the state, the way they conform to federal law that are outlined in this slide. The bottom line is we are now north of about 40 states that have essentially conform to the federal, or states that don't have a personal income tax or that don't tax capital gains. So it's really a finite bunch, but you want to be aware of those certainly, and a number of them are mentioned at the bottom that have either specifically decoupled from the federal and said they're not going to provide the OZ benefits, or they have not modified their state laws to conform to the federal to include either all the 2017 Act changes or OZ in particular. So important to consider. And the one I'll just mention is I'm not sure as of today exactly where California is. That's a biggie because you're talking about a 13.3% top tax rate there marginally, and they have been deliberating this for some time. And there's camps that view it as being extremely important to California to also get on board with this, to be competitive with the other states and to grant this. I think the last I saw, the governor's proposal that was still pending was to conform partially, at least, but they were looking at a targeted approach where only investments in qualifying tracks, certain types of activities like low-income housing and other specified uses would obtain the full benefit. So stay tuned, for that. And just again, underlying, it's very important to know what the state is doing. And on the following slide, the point there is a number of states also, in order to not only conform to the federal, but to make their state look more attractive to potential OZ investors, whether that's to retain the dollars of the capital gain dollars from investors in the state or to attract out-of-state money. States have enacted special benefits in addition to allowing for the state deferral potential exclusion like the federal does, but things like tax credits for investments. And so I won't run through the details of the next couple of slides, which talk about the Ohio program, which has not yet been enacted. But Ohio, both the House and the Senate in Ohio have passed identical bills, and the governor has a proposal that's almost the same. This is now pending as part of the state's budget process, which is due to be decided momentarily. So it's likely this will be enacted, and it provides a 10% credit to individuals on top of the other benefits for investments in Ohio zones. So take a look at other states as well, because there are some that offer perks and things like credits for certain types of investments in low-income zones. So the state tax is important on top of the federal. And then lastly, I just want to make a plug for Section 1031, which is still very much alive as it relates to only real estate. It was, of course, carved back under the 2017 Act and now be limited to real estate. But to the extent that you have a real estate disposition, 1031 does offer some advantages. relative to OZ. There's also some disadvantages. So in that space, it's important, I think, to take a look as you're approaching a disposition and doing your planning to not ignore like-kind exchanges if you have real estate, because it hasn't been totally subsumed by OZ. And something also to note that the two can be used. So in the context of a real estate sale, given the time frames of the programs, it is possible to set up for a 1031 exchange, and then to the extent your 1031 does not work out, it is still conceivable that you could, while receiving the dollars which ordinarily would be taxable under the 1031 rules, if you're able to timely still invest in a qualifying opportunity fund, you still may be able to obtain opportunity fund benefits, and so the two are not incompatible, and please keep that in mind. So with that, I think we've come to the end of our hour. So I would just like to note that, as we previously mentioned, the slide deck and the recording of the webinar will be emailed to all attendees. If you're applying for CLE credit, please stay logged into the presentation system for the questionnaire to appear. Please make sure you answer all of the questions. And thank you all again very much for joining us today. We really hope that you found the program to be helpful and informative.